everyone, this is the afternoon of the 13th of September. So it's a midday recording and the markets are sort of very dull. Nifty is not really doing much, plus or minus 10 points at this point of time. And what I think is going on is some kind of consolidation before we start trending higher. I think there have been a couple of news reports about my view that we are still looking at 17,600 to 17,800 in the days ahead. 17,620 I think becomes the next first hurdle on the way up. The main concern that people have had is probably the overbought reading that you see purely looking at the RSI indicator. Now that's a concern for me as well. There are a couple of stocks that are there. They can probably pause, but the great thing about this market has been rotation, and that continues to go on. And so there are various sectors that continue to support the move, which is why it's not necessary that the high reading leads to an immediate impact. In fact, if you just look at the history of RSI readings, I did this once for the Dow Jones as well. You know, when it was hitting an 80 kind of RSI or more, maybe 85 a couple of years back, I went and looked back when exactly was there a high reading and a top at the same time. And I went back 50 years before I could even find maybe a relevant reading. I don't know if I found something or not, but I had to really go back 50 years. So that's how rare it is. Most of the time what ends up happening is when you get a very high reading, you'll also end up with a brief decline, which may sort of bring out that overbought condition. The RSI goes back to 70, and then again you get higher highs that result in a negative divergence in the RSI indicator. And so you rarely get a peak just because you have a higher reading. You know, the high reading can only get you a one-day knee-jerk reaction, or sometimes just a slow pullback that sort of relieves that RSI pressure. And then it's only after you get a secondary move higher to new highs that you develop negative divergences on the daily chart, and then you probably get that pullback. So this is very important to understand, because you just can't look at a single data point and think that this is the end all and be all of the current condition. So what's really been different in this entire move compared to the last bull run, when you really go back to 9/11 and look at that bottom, first of all, right after that panic low, the markets did recover, but you went through this long consolidation phase all the way to 2003. And then you had the first leap forward. Now in that first leap forward, the index doubled in a matter of 6 months. And then you got a steep correction over the next 4 to 5 months. Initially slowly, and then a very sharp one when you had the 2004 elections. That has stuck so much in the memory of a lot of people making the forecast today that they don't think of that move extending longer, which is now already happened both in time and price, because we've more than doubled and we've taken more than 6 months. So the Nifty is, while it's doing something similar based on the macro data, okay, that you have a dollar bear market, you have commodity reflation, all of those things were there back then, and you're still waiting for growth to pick up. And by 2004, when that correction happened, growth was somewhere around 10-15% on the earnings, and people are just upgrading numbers, and then eventually numbers caught up with the market. So this time around, what has happened is the markets have reflated much faster. You haven't had a W bottom, you've had a V-shaped recovery. And because of a lot of intervention and central bank action, both governments stepping in saying we'll do this or we'll do that the markets have sort of priced in a lot of things ahead. And at the same time, there's still value somewhere which is causing this rotation. So, if something goes down, something else starts moving, something else goes down, something else starts moving. And because of that, you're not really getting a meaningful pullback. The other fear that people started getting recently because of the Fed talk has been around what they've been comparing with is the taper tantrum, right? In fact, I went and searched for articles on the last taper, and all I got was taper tantrum articles. It's like everybody's written about the taper tantrum. It must be like a peak in Google searches at one point of time. People were talking more about the tantrum than the taper itself. Now, why am I emphasizing on that is because while the tantrum reflects only the message or the language of the Fed when they last decided to actually do the taper, so that tantrum was nothing but their language and then the markets interpretation of that. And when they actually started to do it, a month down the line, the market started to recover, and then for the entire next 12 months, the market was in a recovery phase. Now, of course, once they completed that process, you had a couple of up and down moves, but nothing big happened. There was a slightly steeper correction a year down the line, and that was just ahead of the US election. So the US market, of course, seriously only picked up after Donald Trump came in with his tax cuts. So till that point of time, you can say, okay, the market lost some of this theme, but it didn't go into an outright collapse or something like that, which is what people are trying to say. And the narratives were very, very similar. People were saying that, oh, they're going to, taper into a slowdown and that's bad. And that's the same kind of thing you're hearing today. So is it going to be bad or not? Completely depends on how they manage the situation. And of course, like I said, the tapering itself, because, tapering simply means that it's not that you're overnight stopping your bond purchase program, but you probably slow it down. Instead of doing 100 billion, you'll say, okay, next month I'm going to do 105. And then next month I'm going to do 100. And whether it's a month or 2 months, we don't know. It may be a quarterly reduction. So it completely depends on the Fed's interpretation of the liquidity situation and how well they think the markets will handle it. And they'll accordingly, play that out. I think the harder part really was when they tried to raise interest rates. That's when it didn't go beyond 2 rate hikes, and the moment they did the second one and the market started to sell off, they turned around and cut rates again. So I think that was harder. It was not the taper that was harder. The harder part was really trying to raise interest rates, given that the debt burden is so high. So I think that's the bigger risk that markets will always feel every time bond yields rise. But as I've discussed many times before, rising bond yields are not always reflective of rising interest rates. So the Fed rate could be the same, and yields could rise simply because that's a market force, and the market force is essentially equities rising and therefore bond prices falling, which is nothing but the risk parity trade, where fund flows move from equities to bonds. People essentially end up selling their equity exposures to buy bonds, or they end up selling their bond exposures to buy equity. So this is a constant asset allocation that a lot of funds automatically do in the US, and therefore that sort of reflects in this inverse correlation that you see between bonds and equities. So that's going to happen. It happened last year. You had yields rising, people got a bit scared, but that didn't affect equities. And now equities went through some corrective phase. In between, you had bond yields going down again. Now again, they're showing signs of they may rise. They haven't started to rise meaningfully. But I do think if you get that next round of stimulus from the US, which they've been over and over talking about, and they pass it through at some point of time, that triggers another round of reflation, falling dollar, rising commodity prices, some inflation, bond yields go up. So same thing starts to play over and over. And of course, what you really look for is, US growth coming through from that spending, which is if it's really allocated to a lot of infra spend. So that leads to the capex cycle. And so you actually get an actual revival in terms of earnings, which therefore makes the rising bond yields look more appealing and actually reflective of the return to growth environment. I think that's the other thing which can play out in the next 6 months, 8 months, which you need to watch out for. And so, which is why the immediate risks, to a slowdown while they appear around the corner, may more be of base effects, because you had base effects that make look the growth high, but on a quarter-to-quarter basis, because of the lockdown ending now and a lot of the unlocked trade playing out, after that you'll suddenly see growth flatten. But it's really the government stepping in with their spending plans that is supposed to provide that support and provide the base from there on. So that's I think sort of anticipated everywhere, including in India, given their last year's budget, which was a slightly expansionary and not going overboard. I think they'll continue to maintain that stance, and if they do, then we'll continue to get that economic support at the bottom end, which is why you need to focus on sectors where there's value, which is also a lot. You don't necessarily have to be in the most valued spaces, and those sectors which have worked well in the previous cycle. So always cycles change. What works in the last 10 years, like things like FMCG and so on, the defensive, they may go up in a bull run, but they may do less, might not do as well as they probably would have done in the previous phase, and you find completely new sectors doing well. So far that's been metals, but I wouldn't be surprised if you see capital goods, power, and the PSUs, which are sort of in every space, sort of start doing well, because those are both got value at the same time. With the government finally talking about unlocking that sector, it may play out in a bigger way. I know a lot of people are skeptical about the government taking action there, but they've said it, and I would hope that as we get closer and closer to, or maybe much ahead of the 2024 elections, they'll probably do something big. It would be surprising to see that they wouldn't, after having made all those big announcements, because they've actually pulled through a lot of things that were pending for years and years and decades in terms of reforms, whether they were liked or not liked. They've actually pulled those through the pandemic, and would really want to see if they can even pull this one through, because talk of, PSU divestment has been one of the oldest things, started by, the early reforms with Manmohan Singh announcing we should do this and we should. But one thing is saying we should, and one thing is actually getting it done. So everyone was scared of getting it done because of the hit back, because these are large sectors, a lot of employee base, and so that means a lot of voters. But will it happen this time around after such a strong announcement? At least the market has room to re-rate it. In general, if you get some kind of an economic pickup, then there's room for this thing to for these sectors to anyway play out from the high value stage. So the only short-term concern that we continue to watch for in the market ends up being the dollar. And the dollar itself, my long-term view, completely unchanged, remains in a long-term bear market. So what is this risk with the dollar? It's only very, very short-term according to me. Everybody else that I keep reading online keep worrying about it going back to 95, 96 or even 100 or 104. My sense is none of that is happening. Everything that has happened in the dollar so far is counter-trend in nature, looks corrective. The only issue is very, very short-term. So it might not matter so much because, the market usually knows better than everybody else. And if the market didn't know that the dollar was going to go down, then through all these dollar bounces, you wouldn't really be seeing new 52-week highs, or in fact all-time highs in prices of aluminium. You wouldn't be seeing, a nice long consolidation in copper and an attempt to actually break out in the last couple of days. So those kind of moves, you've seen a new 52-week high in zinc, and none of that really reflects what is happening on the dollar. You have seen equity price corrections, like the S&P is corrected over the last 4 to 5 days. But then that sort of brought it back, closer to the 40-day average, and that's again a support level. So that's about all you get. And if that's about all you're getting, I think the market already knows that these are counter-trend moves. If the market really had a sense that something bigger was happening, you would have already seen that in some of these other places, which you're really not seeing. And therefore, I sense that, the dollar bounce is just a mental fear for people who are still scared that this bubble is about to pop, whereas this is something else building. I don't know whether you've reached bubble stage yet or not. Everything looks elevated, but at the same time there are a lot of moving parts, and therefore no point in jumping to a conclusion on that as of this moment. In fact, not even jumping to the conclusion on what will happen after we get to a certain level. So people keep asking me, okay, what after 16,500? Well, after that, now we've been projecting 17,500 or 600, and now what after that, and then what after 18K? And so let's stop thinking about what after, because in the mood of the after, we are really missing out on the present. I think that's what is ending up happening for a lot of people. And if you focus on what's going on now, we'll figure out what's supposed to really play out later on when we get there. We are not there, and we don't know what it's going to look like when we are there. So really knowing what will happen after cannot be known without knowing what it looks like when you're actually there. You need to have that sense at that point of time. So that's all in this update. The overall reading continues to be optimistic. Only some short-term knee-jerk reactions, 1 to 2 day pullbacks is all we are seeing along this way. Apart from that, the overall trend continues higher with a lot of rotation from one sector to the next. I think that's the overall outlook for the markets going forward. Thank you.